First of all, I want to say thank you for joining our post-presidential election market considerations. Absolutely a hot topic with the new president and administration. And I'm very excited for you to meet our guest presenter today. He's a global economist with New York Life Investments. I'll introduce him in just a moment, but I just want to remind you a little bit about our team and this monthly webinar series. We do have a webinar series every month, or a webinar variety of topics. As many of you know, we have Medicare, Social Security, college savings. Try to bring you some really timely information. They're typically 30 minutes or less. Today's presentation actually is scheduled for about 30 minutes, but we're going to allot some time for questions after. So we might run over a little bit that 30-minute mark. But again, just to remind you, all of our webinars are recorded and they are housed out on our website and our YouTube channel, which is 401k Plan Professionals. Also, if you've registered for this, you will get a recorded link, and we definitely encourage you to share that with your staff, friends, colleagues, anyone who might find this information useful, helpful, interesting. Encourage you to do that. So I do want to go ahead and just introduce our guest speaker. As I mentioned, we have Mike Logalbo. He is with New York Life Investments. Mike's primary responsibility is to bring economic and market research to us as advisors and to the public. Mike does have a really deep passion for macro investing, which probably garnered him the nickname Macro Mike. I love that nickname. And also one of the things we appreciate most about him is he can take some very complex economic concepts and market trends and put it in more simple terms for those of us who are not economists. So we certainly appreciate that. Mike, thank you so much for joining and doing this presentation for us today. I will let you take it away.
Thanks so much, Gina. It's great to be here. It's great to be speaking with everybody. I'll kick it off here. As Gina mentioned, I'll give a quick introduction. I'm an economist, strategist at New York Life Investment Management's investment team. As Gina mentioned, my nickname is Macro Mike. Rather than tell you about my background or education, I'll just tell you they call me Macro Mike because I absolutely love this stuff. Macro to me is the intersection of markets, economics, politics, and geopolicy, and I live there with a view on investing, asset allocations, and portfolio solutions. So I'm really excited to be here to chat with you guys about how we're kind of seeing the markets evolve after the election. So without further ado, we can kick it off. I'll start here with the results of the election slide, with this slide of the results of the election. Obviously, it's a little stale. We know that Nevada and Arizona have been called. And let's first set the stage about the election results because it impacts the likelihood of policy change and investment opportunities. Donald Trump, if you didn't just wake up from a 2-week nap, Donald Trump has won the presidency and won the popular vote. This wasn't the case in 2016 when Trump won the Electoral College, but not the popular vote. There were demographic shifts across the board, moving support towards Trump, and turnout was especially high in battleground states. And I believe this clear support is important for policy. It creates a mandate, a firmer support under the presidency. And it makes it less likely that any legal challenges, especially related to the sentencing in Trump's hush money trial, impede the path to presidency. In terms of the Senate, Republicans also won control of the Senate with 53 seats. This Republican majority in the Senate matters. A majority of 1 or 2 seats makes the view of moderate lawmakers, or perhaps those in cycle for 2026, matter a lot more and potentially hold up the legislative agenda. 53 seats is a relatively healthy margin, and so the Republican-led Senate is a source of policy strength that the party might not have been experiencing. And this effectively does usher in a new era of leadership, influencing cabinet positions, eventually the Fed chair, potentially Supreme Court choices as well. And then finally, the House of Representatives. We know that the Republicans were able to maintain control of the House. They have a decent, not all the races are called, they have a decent margin, but that margin is shrinking based on who Trump has been choosing for cabinet positions. So again, some more moderate House lawmakers on the Republican side may have more power if that majority in this term, in this cycle, if the as that majority shrinks. So all in all, this was really a decisive victory. And on the back of that decisive victory, we saw decisive market moves. Some may unwind, and in fact are still unwinding or unwinding in the coming weeks. But here's a quick overview of what we've seen so far. You can see, especially, we've seen yields really push higher. The U.S. 10-year yield. Now, these numbers and changes are again a little stale, but they still do reflect the environment. Yields are pushing higher. The U.S. term premium. I can talk about that in a second. That's also pushing higher on supply and demand risks. Inflation expectations are also rising on some policy risk. Currencies, we've seen the dollar strengthen. We've seen the dollar strengthen for two reasons. One, U.S. economic outperformance. Two, the threat of tariffs. Tariffs weaken other currencies relative to the US dollar, hence the dollar strengthens. Again, we'll come back to that. And then finally, we've seen a lot of different reactions in sectors. Again, not all of these are completely reflective of the environment. Financials have been performing well. I'll show you a chart of that in a little bit. Consumer discretionary and tech. Energy, while this shows down, this was just a few days after the election. Energy has been one of the best performing sectors, and some parts of healthcare as well can be mixed. And we'll talk about kind of different market reactions here. But what we're seeing in the yield environment is probably most reflects the election outcome. The market started to price in, the market is starting, or really started to price in Trump's fiscal policy, namely the extension of the 2017 tax cuts when Trump odds turned around. And you can see on this chart, I've actually got, you can see where Trump odds bottomed in late September and then turned around in early October. And that's when we saw the market really started to price in a higher 10-year yield and a higher term premium. Tax cuts, why? So now I want to be clear on why the threat of tax cuts is raising yields. Tax cuts reduce government income, so the federal deficit is likely to expand. If you take a look at this chart, it shows the sources of government income in green and the total spending in blue. And the difference there is red. Government spends more than it takes in, so we have a deficit. And the Treasury makes up that deficit by selling bonds in the market to raise the funds to fund the government. If the deficit is likely to expand, that means the Treasury has to issue more bonds. Issuing more bonds increases the supply of bonds. When the supply goes up, price goes down, and with bonds, when price goes down, yields go up. Hence, the market is pricing in a larger deficit. It's expecting that the Treasury is going to need to issue more bonds, more Treasury bills, Treasury notes, Treasury bonds to make up that deficit. And the market is saying, okay, well, you know what? We've seen that as a little risky. So we don't want to take 4% now. We're going to need 5%. And hence the yields are pushing higher. Term premium also is an interesting concept. Term premium represents the supply and demand. As we know, the Treasury curve typically slopes upward. Shorter rates like the 1-year and the 2-year rate are lower, and then the curve in normal times slopes upward. When the curve is flat, it shows that there's no term premium. I could buy a 1-year bond or I could buy a 10-year bond. There's no difference between me buying a 1-year bond and rolling it 9 times than versus that 10-year bond. Term premium represents the risk in holding that 10-year bond instead of 10 of those 1-year bonds. And as the market kind of sees that deficit growing, it's going to price in more risk. It's going to say, you know what? I don't know if you're going to be able to pay me back in 10 years. So I'm going to stick with the 1-year bonds. So again, that's that market risk pricing in. Let's turn, and again, we talked about the tax policies. Actually, I'll show you a real quick slide on here's a quick slide on kind of what Trump is proposing, since I brought up the Tax Cut and Jobs Act. You'll see here you'll see here in this column on the left what the tax situation was before the Tax Cuts and Jobs Act of 2017, or the Trump tax cuts. You'll see the corporate tax rate change from 35 to 21% was permanent. That won't change unless there's existing legislation. All of the other tax rate changes, individual tax cuts, the SALT tax, child tax credit, all of those changes to the tax code, they sunset, they revert at the end of 2025. So We know that obviously running up to the election, we know that both candidates had plans on how to kind of address that, the end of that. And we know that Trump, what he wants to do is extend all of these tax credits. We don't find it likely that the corporate tax rate changes, but income tax rate extensions are more likely. And again, that is likely to increase government spending and increase the deficit. Now let's move on to the dollar and we'll talk about trade. And there's been all kind of prognostication about trade. The Trump campaign's proposals were more, let's say, robust, including both China and universal tariffs on varying levels. So what's the reality here? On the campaign trail, Trump has suggested as much as 60% tariffs on goods from China and 10% tariffs on goods from everywhere else. And we can see the behavior of the dollar, which is strengthening, and many US partner currencies, which are weakening, that tariffs are seen as a credible threat. And we believe that directionality, we are likely to head towards a greater degree of trade restrictions. I also want to pull back here just to be clear on what is a tariff. How does a tariff work? A tariff is a tax paid to the US government. If a US importer imports Brazilian beef and the government imposes a 10% tariff on Brazilian beef, that US importer will pay that tariff. The Brazilian beef cost did not change. But now, in order to make that purchase, the government that importer also has to pay the government the tariff. So tariffs are revenue to the government. Now that beef is more expensive, and all or some of those higher costs are likely passed on to the consumer. So again, that's kind of how tariffs work. They're going to slow global trade and weaken the dollar weaken other currencies relative to the dollar. And there are a few ways that we could see tariffs and these new policies be implemented. We may see the president enact tariffs with executive orders, like in his previous administration, or we may see new tariffs or even existing tariffs be rolled into the budget as a revenue source. But know that this tariff revenue, is very minimal, only makes up about 7% of the budget deficit. The truth here is we believe it's too soon to make conclusions about where tariffs will end up, and therefore what their impact may be on overall trade, domestic production, and inflation. That's because tariffs don't exist in a geopolitical bubble. We may put tariffs on somebody else, they could put tariffs back on us. Other priorities for the US, including national security, immigration, even drug trade cooperation, and defense spending, are likely to be discussed in the same vein as trade policy. But we need to remember our trade partners are not without their own sources of leverage and influence in trade negotiations. So let's start with China. It's very hard to overstate the degree of leverage China has over the US economy and vice versa. China's influence includes control over raw materials. For example, they control over 60% of global silicon, which is used to create computer chips. And they have experimented with export bans of rare earth minerals in the past that our tech industry relies on. China also has heavy influence over, of course, the fate of Taiwan, as well as Russia, Iran, and North Korea. All of this can be used to negotiate around tariffs, not to mention that China is capable of subsidizing many industries to help them remain cost competitive, even if US tariffs are imposed. Moving on to Mexico, which is an interesting situation. The trade deficit the US has with Mexico has been top of mind for Trump since the last time he negotiated the US Mexico Canada trade agreement, and he will do so again in 2026, but this time with new negotiating partners. Canada is going to have a parliamentary election at some point in October and will likely have a new prime minister. And Mexico, for its part, also has a newly elected leftist president in Claudia Sheinbaum. So those so there's some uncertainty around how those negotiations will play out. And finally, you can also consider the quite right-wing European Parliament that was elected in June. Now, trade negotiations done with the European Commission. They are being done with the European Commission, but any new trade agreements approved by the Parliament, the extent of this agreement may alter discussions kind of with the U.S. materially going forward. We all lived through the 2018-2019 trade war with China, and while most of us didn't may not have had a big impact on most of us, it certainly did impact U.S. farmers. And while I wouldn't want to see that kind of play out again, I certainly wouldn't want to see what a trade war with Germany or the UK or European Union would look like. Unless we forget, tariffs do act as a tax, saying that there may be less tariffs than the most extreme suggestion. So we are kind of saying that we do expect there may be fewer tariffs than the most extreme suggestions that were placed. But the impulse does seem also inflationary, right? It's going to raise that it raises import prices. And a lot of the counter argument into these tariffs is, well, okay, well, it will make U.S. companies more competitive. Yes, it would make them more competitive, but not on price. So the prices would still be higher. Secondly, there's also the assumption when it comes to tariffs that if we tariff goods, then we'll just make things here. Currently, the US doesn't make much here. So we buy a lot of it. So it will take time. It could take a decade for us to really kind of rebuild some supply chains. But in the meantime, tariff on those goods is likely there is no import substitution, and we'd likely be kind of seeing those higher prices. And the market has certainly responded as well. As you can see on this slide, I have the 10-year inflation swap, which is really what the market expects inflation to be over the next 10 years. The Fed's target, as we know, the Fed targets inflation of 2%. Right now, the market is expecting, based on this chart, annual inflation to range up to be about 2.5%. So still a little high, and the trend is moving higher. So that's something that should be considered. Now, there's a lot that goes into inflation expectations for economic growth, external shocks, Fed credibility, wage expectations. So we can't attribute the rise in inflation expectations to any one of these things, though we believe tariff expectations and the expectations for a tighter immigration environment are contributing to the rise in inflation expectations. And I can also elaborate on the immigration point here too. We know that population growth and therefore labor growth in the US has been driven by immigration. It's a consensus among economists that higher immigration levels in recent years have been a positive supply boost to the labor market, helping prevent wage growth from becoming too unruly. And I'm not saying that that's what the Fed and the Congressional Budget Office says. Under a second Trump presidency, we do expect a border crackdown, slowing the immigration rate quite quickly, even though I think it's very limited already. But again, we're not going to see an expansion. Now, what remains to be seen is the timing and extent of any deportation plans, which could represent a negative supply shock on the labor market and contribute to upward pressure on wages and be potentially inflationary. This is likely, any policies like this would be more likely to impact labor-sensitive sectors of the economy, labor-intensive sectors of the economy, like agriculture and construction especially. And we've been keeping a close eye on those sectors. And finally, we'll go to one more topic here, and that is regulation. And what do we think is realistic here? What kind of impacts will sectors have? Will the election and sectors investors might find attractive? And what we're seeing in markets is that investors are moving towards sectors that could benefit from Trump's deregulation policies. On this slide, we see the financial sector has reacted positively to Trump's win and the prospect for less regulation. Another sector gaining ground with the election over is the traditional energy sector, which could benefit from less regulation and on oil and natural gas production and exports. Another sector that we think that could actually that the trade could disappear that's benefited in the near term has been the technology sector, and many investors are expecting that to be with a less hawkish, a more lenient director of mergers and or a kind of overseer of mergers and acquisitions. There'll be more mergers and acquisition activity, and that should be good for that sector. However, we're advising caution here because many of these tech companies could be negatively impacted by Trump's tariffs, especially tariffs on China, because they maintain a lot of their supply chain through China. Again, where most of our computer chips, or at least the raw materials that go into our computer chips, we buy from China. So let's take a second here and kind of summarize what this means for investments, and then I'm again be happy to take some questions. So first, policy can be unpredictable. So I think it's important to level set on what investors can really know at this point. So what do investors know? We know that the extent of the Republican victory matters because it broadens the case for real policy change. And it's real policy change that matters. Lots of things are going to get said in the next 4 years. Lots of things are going to get tweeted. Lots of breaking alerts are going to come to your phone, and they could be scary, but it's really the likelihood of what will be moving forward and what's actually enacted that really matters for the market. We also think there are going to be changes to trade and tariffs and immigration and tax policy and regulation that will drive investment outcomes. Now, what we don't know is a few things. Typically, firstly, how inflation and tariffs will come together to impact growth exactly. As I mentioned, there are many routes for escalation here. Most investors, ourselves included, are estimating extreme proposals and then walking them back because, we're just not sure how this could all play out. We don't know how trade and other geopolitical changes in China, the Middle East, or Russia will evolve. Just think how different the world is from these geopolitical changes the last 4 years. And again, these are things that we simply can't handicap. And though we're confident there will be changes to immigration policy, at least shutting down the border and defunding visa proposals or visa processing, we don't know how far policies like deportation could go. So let's take a step back and take a look at what that means for holistic asset allocation. So remember that all of this is coming on the back of the U.S. A U.S. economic environment that is strong and very, very healthy. Real GDP growth was about 3.5% in the third quarter, far above trend. Inflation has been normalizing, the labor market has been normalizing, and corporate earnings are still very healthy. At the same time, interest rates are moving down. The Fed is cutting interest rates. So in our view, we think it's time to sort of lock in higher rates, especially at the shorter end of the curve. As I mentioned early, we're seeing pressures kind of push up the long end, but we think it's the shorter end will move more in line with Fed cuts. And we think it's worth investors kind of moving from cash into short duration assets. For those not familiar with the term duration, what do I mean here? That's where we are on the yield curve. Duration is a measure in years. It's a measure of interest rate sensitivity in years. So a 2-year bond is 2 years of duration, a 10-year bond, close to 10 years of duration. So we like, in terms of shorter duration bonds, we like staying on the shorter end of the yield curve with shorter duration bonds because we do see that pressure on the long end. And if yields go up, prices go down. So with bonds. So we like, again, in the short end, we like short duration credit, quality high yield municipal bonds also have good short options. High quality leverage loans, floating rate yields are still high. And we think those floating rate bonds are still very attractive. There we go. Resilient growth may also slow the cycle. We're cautious on where we are adding duration. Many investors are like, well, I think it's the time to buy longer duration bonds. Where should I buy these long bonds? Yields are high. Where should I buy them? Again, as I mentioned, we see the 10-year yield moving higher. So that's going to, that could lower prices. Where do we see healthier duration plays? In the municipal bond curve. This bond curve, the municipal bond curve has more term premium incorporated into it. And we think, and again, as you know, municipal bonds, interest return is tax exempt. And so we like the muni bond curve. What else are we talking about here? The strong growth does make the Fed move slower than expected. And the combination of factors alongside some of these global changes in areas like artificial intelligence and the sector supporting it may mean the equity market has room to run until the normal economic cycle sort of plays through. And what that means, we like staying invested in equities. We're not selling our equities, but we're diversifying our equity exposure. We're not all just big tech. We do like larger companies. We think they're a better play than smaller ones at this point in the cycle. We're also looking for companies that can benefit from rate cuts, companies that pay dividends, infrastructure equity we think can benefit from the artificial intelligence and semiconductor investments. Real estate equities typically benefit as rates come down. And again, we also tell investors, if you already have a lot of equity exposure, you can also consider taking some of that equity exposure in some more higher yielding fixed income assets. And then finally, we're looking at, this red wave has driven policy change. And again, the key takeaway here is focus on real policy change, not what gets said, not what Fox News said or what CNN tweets out or all these breaking alerts. Try and sift through the noise. Talk to your advisors. That's what they're there for. They talk to us. We have relations. That's what they're there for, to kind of help you kind of get through all this noise and whatnot. So focus on the real policy change. In terms of the election, we're being careful about interest rate risk. Yields are, we're seeing the election push yields higher. Bipartisanship still does matter. We have, where did we see some bipartisanship in that first term? Obviously, defense spending, and we expect more defense spending, defense technology spending as well. Energy, both traditional old energy and affordable new energy. What do I mean by that? Well, many people don't know that Biden actually permitted more oil drilling, and the U.S. has been drilling more oil at the end of and currently than we were at the end of Trump's term. The U.S. is actually the #1 energy exporter at this point in the cycle. So I think that's going to continue to grow as both kind of as Democrats also kind of see the benefit in terms of consumer prices in traditional energy sources. What about clean energy sources? Will we see all of those stuff? Will we see all of that get pulled back? A lot of the investments there were made in the Inflation Reduction Act, and we don't think many of the clean energy investments will get pushed back. The clean energy investments, the investments in the Inflation Reduction Act were made, to help boost clean energy investments, and including for solar and electric vehicle credits. However, and also investments for building these plants and production facilities. And most of the investment, at least 63% of the investment from the Inflation Reduction Act, was directed towards Republican-held districts and Republican-held states. And they created a lot of jobs and growth in those areas. So revoking that, pulling that back, we do think would be politically challenging. So again, we think both, old and traditional energy and new clean energy sources are excellent, or could be good sources of return. Finally, we really like the infrastructure play. As artificial intelligence is here. It's going to stick around. We're seeing a lot of excitement around it, a lot of investment around it. We always get questions on how do I play that? Am I too late to the AI trade? NVIDIA is too expensive. Microsoft is too expensive. How can I play the AI trade? The way we like to play it, focus on infrastructure. Focus on the infrastructure that's needed to build this out. So, for example, I'll give you an analogy. When the car was invented, when Ford invented the car, you could have bought stock in the car company, but let's say there were 3 car companies, Ford and 2 others. Maybe you didn't know which car company was going to last out, but you did know that cars were going to stick around. So you would know that we'd probably need a lot more rubber, a lot more concrete, a lot more infrastructure. So that's the same kind of angle we're taking in terms of artificial intelligence. Yes, you can buy these tech companies and they're very expensive, but also let's look for the companies who's laying the 5G cables, the 5G, the fiber optic cables, who's building the 5G satellite towers, who is building the data centers, who's building the power generation that's going to be required to fuel these data centers so they can kind of maintain all this compute and processing power for this artificial intelligence. So we really like the infrastructure play there. And then finally, we look at many Trump trades are, around volatile asset classes. We do think the dollar is strong now. We think could maintain some strength. Bitcoin also has seen a boost on low regulation prospects, but we obviously advise caution there because there's a lot of volatility in that asset class. And I think with that, I am going to wrap up and open it up for questions. Hopefully this was helpful, and I'd be happy to answer whatever I can.
Great. That was awesome, Mike. Thank you so much. And I did forget to mention at the beginning of the presentation, please feel free to ask questions. You can put those in the Q&A or chat. So we'll give folks a couple minutes to do that. Yeah, and this is interesting, I think, Mike, while we're waiting for people to put questions in there, because we have clients in, just about every industry that you mentioned, whether it's, healthcare, financial, manufacturing. So it is interesting to see
Hmm.
the differences on how policy changes, regulatory changes could change their jobs,
Hmm.
possibly their profitability. So yeah, that was interesting. And I think one of the biggest questions that I've had
Hmm.
that you did answer was on inflation.
Hmm.
And I think there were some inflation fears out there. I think you did a good job
Hmm.
of maybe, helping to curb the fear that,
Hmm.
inflation tariffs are not
Yeah.
necessarily make things
Hmm.
spike as much as some people thought. So
Hmm.
yeah, so I think that's really interesting. So, um, all right. I don't have any questions yet, but I know I don't have a shy group here. So if you're able to take yourself off mute, I'm not sure if you certainly can
Yeah,
do
you're more
that
than
too,
welcome
but
to.
like I said, the Q&A might be a little easier to submit some of those questions. And I will also mention too, if you think of some questions afterwards, you can certainly email our team. We
Hmm.
can reconnect with Mike. Um, he's the expert on some of these economic concepts. So if you think of something else or you don't want to ask in front of the group, um, definitely reach out to our team as well. Also, while we're waiting for questions, Mike, maybe you could go ahead just to our last couple
Hmm.
slides. I'll mention those two. So kind of hopping off, the economics. Again, I do want to mention that this will be recorded. You can find that out on our YouTube channel and our website. If you've registered, you will get that recorded link. As I mentioned, you can share that with your staff. Also, just wanted to tee up a couple other presentations we have coming up. One of our most popular ones is in January. It's our annual retirement planning considerations and market update with Marta Rodriguez from JP Morgan. Jenna also does her quarterly training. She's got another quarterly training, fiduciary training coming up in February. Also, we've got the LinkedIn gal. She'll be great. She's in March, so helping you use LinkedIn to promote your organization. And also, very favorite presentation of mine called 8,000 Days of Retirement. Americans are estimated to live 8,000 days in retirement. That's going to include some SHRM credit. That is by John Deal with Hartford Funds. If you've been to any of our fiduciary summits, you've probably seen John, and he's a fantastic speaker. So those are kind of tease up the first part of 2025. Hard to say that, 2025. It's around the corner. So just wanted to mention that. As always, you can reach out to our team with any questions. There is the QR code if you want to use that to register for those upcoming webinars. And again, you can go to our website as well. We also send out drips so you can register for the upcoming webinars as well. I don't see any questions. Mike, I thought it was fascinating. Thank you. I took a whole page of notes. So I really, really appreciate your expertise and your time this morning. Again, thank you everyone for joining us today. Have a fantastic day and happy holidays. Mike, I appreciate it.
All right. Thank you very much. Have a great day, everyone. And again, if any questions come up, we can get back in touch. So again, feel free to reach out.
Awesome. All right. Thanks again, Mike.
Thanks.